How do you invest less and make more? In this fifth video of the Muslim Investing 101 series, we'll find out. The second mental shortcut that we need to remember is that compounding is weird, and the action step here is to start now. We studied compounding many years ago, maybe, when we learned the difference between compound and linear growth. We'll show an example of that in just a moment. The thing to remember now, as we are adults moving through the world of personal finance, is that our understanding of compounding and how it works is one thing, but our ability to actually compute it and visualize it in our minds is quite limited. And so we don't compute compounding well in our minds. That's really important to remember. To illustrate this, let's look at two characters, Akram and Tariq, and they are both interested in saving/investing. Akram starts saving/investing at the age of 31, and his friend Tariq begins 10 years before him at the age of 21, but stops. And this is a critical point. He stops at the age of 31. So he stops, and then Akram begins at the age of 31. Let's take a look to see how Akram's wealth grows over time. In the first instance, this is Akram saving money just as cash in his bank, $200 a month, from the age of 31 all the way until his retirement age around the age of 67. If he did that, he would have around $88,000. Of course, this is not adjusted for inflation, and generally speaking, for illustrative purposes, we don't make those adjustments. So that's Akram's saving potential between the ages of 31 to 67, $88,000, which isn't bad, but it's not great because had he, rather than putting it in box A, which is cash, if he had put it in box C, he would have nearly $1 million, $939,732. That's the difference between compound growth, which is the orange line, and linear growth, which is the gray line. That's what $200 a month does to an investment over the long term. You can see the compound growth and how difficult it is to compute in our minds that number. To go from $200 a month from the age of 31 to 67, coming up with $1 million is hard. You end up having to use a calculator to figure this out. So that's Akram. And Akram does well. He ends with $1 million. But let's compare that to his friend Tariq. Now remember that Tariq invests $200 a month and he stops at the age of 31. So Tariq only puts in $24,000. $200 a month, stops at the age of 31. That's what his linear growth until the age of 31 looks like, and then it goes flat until the age of 67 when he retires. The one thing, of course, that Tariq has that Akram does not have is a 10-year head start. So they end at the same point, but they begin at different points. And this is what Tariq's growth looks like if he invests it. $1,645,000. So over $1.5 million is what Tariq has. Having put in only $24,000, he has significantly more than Akram because he started 10 years earlier than Akram. And he put in just a fraction of what Akram put in. That is the difference between Akram and Tariq. What this is meant to illustrate is the difference between a little money being invested over a longer period of time versus a bigger sum of money being invested over a shorter period of time. Time wins in the game of compounding, and that's the game that you're involved in when you're investing in the market. You're involved in the compounding game, and so a little bit over a longer period of time is better than a lot over a shorter period of time. There's another way to think about this. If we imagine that we saved $1 in the market in box C and didn't open it until we were 65 years old, here's what we would find. Let's first imagine if we put in $1 at the age of 60. If we opened it 5 years later at the age of 65, we'd have $1.35. If we first put that dollar in at the age of 55 and opened it 10 years later at the age of 65, we'd have $1.91. If we rewound the tape 5 years, $2.85, $4.46, $7.34, $12.69. At the age of 30, if we started then, it would be $23.06 at the age of 65, $44.06 at the age of 25, and at the age of 20, if we put in $1 at the age of 20 and didn't touch it until the age of 65, that would be $88.35. Notice how steep the incline is on this bar graph. The sooner we start, the better it is. Now, a lot of you looking at this chart will think, Well, I'm not 20 years old anymore. I'm not 25. Maybe I'm in my 40s. And this is really key here. No matter what, the best time to start investing was probably yesterday, and the next best time to start is today. And so no matter where you are on that chart, today is the best day to begin. Compounding is weird, yes, but the action step is that we should start right now. This video is part of the Muslim Investing 101 series. Be sure to check out the entire playlist. And if you find the videos on this channel beneficial, please like, subscribe, and share.